Welcome to the Money Matters Show, where I explore the money topics that matter most to you. I'm your host, Steve Balch. Join me as I share expert insights, actionable strategies, and meaningful conversations to help you protect, grow, and optimize your wealth. Let's dive into what really matters when it comes to your financial future. Welcome to episode 2 of the Money Matters Show. We're going to talk about health savings accounts today. We're going to discuss what they are, why you should use them, how best to use them, how they can basically be an extra savings account for you, and what are some of the advantages essentially. So first off, what is a health savings account? It is a tax advantage savings account designed to help pay for qualified medical expenses. You are only eligible for this if you have a high deductible insurance plan. So if you have a high deductible insurance plan, either as a self-employed individual or through your company, you are eligible for a health savings account. The funds go in pre-tax, grow tax-free, and can be withdrawn tax-free if you use them for qualified medical expenses. So that's a great thing. Triple tax is a wonderful advantage to take advantage of. You get deduction now, you get the money to grow tax deferred, and you get tax-free growth if you use them for qualified medical expenses. So what are some of the limits for 2025? If you are a single individual, the limit for 2025 is going to be $4,300. If you are a family, the limit you can contribute is $8,550. So if your cash flow allows for it, I would highly recommend trying to max out your health savings account if you are eligible for that in 2025. If you are over 55 years old, there is an additional $1,000 catch-up you can contribute. So if you are a family, you and your spouse and a child, and you have and you're over 55 years old, you can contribute roughly $9,550 this year. So that is a direct deduction off of your taxes, and then that money grows tax deferred. And if you need to pay for medical expenses, then that money grows tax-free. So that's a phenomenal baseline of how the health savings account works. Now, what do you need to be eligible to get into a health savings account? Well, number one, you have to have a high deductible plan, as we talked about earlier. Number two, you cannot be claimed as a dependent on someone else's tax return. And number three, you cannot be enrolled in Medicare. So ultimately, you have to be under 65 years old, have to be in a high deductible plan, and you can't be dependent of someone else. So we talked about essentially what the limits are: $4,300 for an individual and $8,550 for a family. And that catch-up contribution if you are over 55 years old. So how would I use this, right? Ultimately, the best way to use this is to think of this as another savings account for yourself. If your cash flow allows for it, you should max out the health savings account, get the deduction for this year, and then any medical bills you have, doctor's visits, surgeries, prescriptions, dental, whatever it may be, take all the receipts you have, scan them in, and keep them in a folder. So if we go back to say 2023, you should have a folder of all your medical expenses from 2023 for 2024 and start one for 2025. Then all your bills you get, try to pay them with your cash flow if you can. If you can pay the bills with your cash flow, then everything in your HSA, you can invest those funds. So those funds can be invested, grow tax deferred, and then later on, next year, 10 years down the road, or when you get into retirement, you can go and take the receipt you have saved in those folders that you've scanned in, submit the receipt, and pay yourself back. So ultimately, the health savings account, if your cash flow allows for it, can be another tax deferred, tax-free type of retirement savings account for yourself, right? So that's what I personally do. Luckily, right, I have enough cash flow between my wife and myself working, and we have a high deductible insurance plan. Any bills that my wife has, that I have, that our kids have, I typically try to pay them with our cash flow. If there's a bigger one and cash flow gets tight, I can take it out of the HSA and make sure to max that out. A lot of companies, if you work for a corporation, will essentially also give you some sort of contribution. Maybe it's $500, $1,000, $2,000. It depends on every company. That's something to look at when you sign up for your benefits. Now, take into account if the maximum is $8,550 and the company gives you $1,000, you can only contribute yourself then an additional $7,550. Make sure that you're not putting the full 8,550 in, or you're going to get penalties and you don't want to have to back it out and deal with that extra tax prep work. So look at that whole situation. But ultimately, we look to fund and max out our HSA account. And I put those funds into a long-term savings account. I keep roughly my deductible in cash as a protection. So if something does happen, cash flow gets tight, things are variable this year, I know that I can always pay for my deductible this year. And anything above the deductible, I leave into long-term growth. I keep receipts of everything that I have in different folders. And so if I need to pay myself back next year, hopefully I don't pay myself for long periods of time, that money is invested to grow long term. So for instance, let's say that I had medical bills of $2,000. I would scan in that receipt, pay those various bills through my cash flow, put it on my credit card, and then pay my credit card off. And then I would keep that HSA saved. And then when I get to 50, 60, 65 years old, I can go and submit those medical bills and take out the $2,000 later on. That then essentially becomes a tax-free income vehicle for myself, right? Because that money was a deduction this year for me. It grows tax deferred. And because I'm paying myself back for qualified medical expenses, there's no limit as to when you pay yourself back with the HSA. I'm giving myself tax-free income. Additionally, when you get to 65, you can take money out that's not qualified medical expenses. There's no penalty, but you pay it like you would pay ordinary income taxes. So essentially it becomes another IRA. So if you have the cash flow, the HSA is a phenomenal way to be able to create another investment vehicle, retirement vehicle for yourself that you can use before you get to 59 and a half or after. So let's look at potentially how and why you'd want to invest these funds and how long-term growth can help you accelerate your nest egg. All right, so again, we want to think of the health savings account, if possible, if your cash flow allows for it, as another savings type retirement account, right? So think about if we were to be even the single contributions, $4,300 for this year, and we are, let's say, in our mid-30s, and we're starting this year, and we have a 30-year time horizon we're investing. And our rate of return is 6%, right? Let's think of a realistic return here, right? Moderately aggressive. US market over historical times is an 8 to 10%. Let's be real here and give this a moderate growth of 6% a year. And we're going to put in the $4,300. So we're going to max it out every single year. We're not going to get into the complications of doing the extra 1,000 when we get to 55 and everything, right? So if I were to put as a single participant in a high deductible health insurance plan, if I were to put $4,300 into my HSA this year and do that for 30 years over a 6% return, that over 30 years will grow to roughly $364,000, right? So that's a nice nest egg to have. And if you were to then pay yourself back with the receipt you have, the money coming out can be tax-free. So that acts more as a Roth for yourself. Let's say that you were a family and you and your partner or you and your spouse are working and you were able to put, even if we did, say, conservative 5%, and we're able to max out again over a 30-year period, that's an extra $600,000 on top of what else you're doing. So the HSA in general gives you a wonderful ability to help take your taxes down this year, like an IRA contribution does, helps you grow the money tax deferred, and helps you pay for qualified medical expenses now or in the future tax-free, right? So overall, giving you an idea of, hey, even if we don't get phenomenal returns in a moderately aggressive portfolio over the next 20 or 30 years, even just being able to max out and put that money away and not touch that money gives you a tremendous addition to your nest egg and flexibility in retirement. So in summary, right? if you have a high deductible plan at work, I highly recommend looking into the HSA account. And especially look into the fact that if your employer is giving you some sort of match or contribution, make sure that you're taking advantage of that and looking at it. If you have the cash flow, the best way to look at the HSA is to keep your deductible in cash, so protect you for emergencies for this year and going forward, and then anything excess and above your deductible, put into savings for long-term growth, right? That money is a tax deduction for this year, gross tax deferred, and if used for qualified medical expenses, ends up being a tax-free expense to you, right? Once you get to 65, then those funds can be used for anything that you want. There's no penalty, but you do end up paying taxes like it is an IRA. So think of the HSA as essentially a third type of retirement bucket that gives you triple tax-free growth. If your cash flow allows for it, pay for your medical expenses through the bills and cash flow that you currently have and savings that you have, and save all your receipts to pay yourself back in the future. If you have any questions, feel free to reach out. I'm happy to help. Thank you for listening, and follow and like for more information of how to help yourself as a high net worth individual. The information given here is taken from sources of IFP Advisors LLC, DBA Independent Financial Partners, IFP Securities LLC, DBA Independent Financial Partners, and its advisors are believed to be reliable, but is not guaranteed by us as to the accuracy or completeness. This is for informational purposes only, and in no event should be constructed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and or legal advisor before implementing any tax and or legal related strategies mentioned in this publication, as IFP does not provide tax and or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situations, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express consent, prior written consent. Investment advice offered through IFP Advisors, LLC, DBA Independent Financial Partners, a registered investment advisor. IFP and Certa Financial Planning are not affiliated.